In 2008, the global financial system nearly stopped breathing. Banks were collapsing, credit markets were freezing, companies couldn't roll over their debt. Even giants like General Electric were suddenly struggling to borrow money for basic operations. And in the middle of that panic, one thing became desperately scarce. Not gold, not oil, not government bonds, dollars. Around the world, banks and corporations were scrambling for US dollars like oxygen. European banks needed them. Asian exporters needed them. Emerging markets needed them. The strange part? Most of those institutions were nowhere near the United States, yet the entire global financial system was suddenly starving for American currency. That moment revealed something most people rarely think about. The US dollar isn't just America's money, it's the operating system of the global economy. And the reason it stays on top isn't just because the United States is powerful. It's because the entire system is quietly built around it. To understand how strange this is, imagine if the whole world ran on one company's software. Every business, every government, every financial institution, even if they didn't want to. That's basically what happened with the dollar. Today, nearly 90% of global foreign exchange transactions involve the US dollar. About half of all international trade is priced in dollars. Roughly 60% of global central bank reserves are held in dollar assets. But here's the key detail. The United States economy is only about a quarter of global GDP. So why does one country's currency dominate everything else? The answer isn't just history. It's a system, a network of incentives, habits, and financial plumbing that quietly reinforces the dollar's position every single day. And once you see how it works, it becomes very hard to imagine the world without it. The story begins in 1944. World War II was still raging, but the outcome was becoming clear. Europe was devastated. Much of Asia was in ruins. Industrial capacity across the world had been shattered. One country stood in a completely different position, the United States. Its factories were intact. Its economy had exploded during the war. And most importantly, it held around 2/3 of the world's gold reserves. So representatives from 44 countries gathered at a quiet resort in New Hampshire called Bretton Woods. Their goal was simple: design a new global financial system. The system they created was elegant. Currencies would be tied to the US dollar, and the US dollar would be tied to gold, $35 per ounce. This meant that the dollar effectively became the center of the world's monetary system. If a country needed stability, it held dollars. If it wanted to trade internationally, it used dollars. If its currency wobbled, it relied on dollars to stabilize it. For a while, the system worked beautifully. Global trade expanded. Economies rebuilt. Financial markets grew. But by the late 1960s, a problem appeared. The world needed more and more dollars to support growing trade, but the United States didn't have enough gold to back all of them. In 1971, President Richard Nixon made a decision that shocked the world. He ended the dollar's convertibility into gold. Just like that, the dollar became a pure fiat currency. No gold backing, no hard anchor. In theory, that should have weakened the dollar's global role. Instead, something strange happened. The system doubled down on it, because by that point, the dollar had already become deeply embedded in global finance. Take oil. In the 1970s, the United States reached an agreement with Saudi Arabia and other oil-producing nations. Oil would be priced and sold in dollars. This created something economists call the petrodollar system. If a country wanted to buy oil, it needed dollars. If it needed dollars, it had to either export goods to the United States or borrow dollars from the global financial system. That alone created enormous demand for the currency. But the real engine keeping the dollar on top isn't oil. It's finance. Modern finance runs on dollar-denominated assets. U.S. Treasury bonds are considered the safest and most liquid financial instruments in the world. Central banks hold them. Pension funds hold them. Insurance companies hold them. Foreign governments hold trillions of them. Why? Because they need a place to park massive amounts of money safely. and there simply aren't many alternatives. The Eurozone has fragmented debt markets. Japan's bond market is huge, but mostly domestic. China's financial system remains heavily controlled. The United States, meanwhile, offers something rare: a gigantic supply of relatively safe assets. Right now, the U.S. Treasury market is over $25 trillion. It's deep, liquid, and constantly traded. That makes it the backbone of global finance. But here's where things get even more interesting. A huge amount of dollar activity actually happens outside the United States. This system is called the Eurodollar market. Despite the name, it has nothing to do with the euro currency. Eurodollars are simply US dollars held in banks outside the United States: London, Singapore, Hong Kong. These financial hubs move trillions of offshore dollars every day. Banks lend them, corporations borrow them, governments issue bonds in them, and the scale is enormous. No one even knows the exact size of the Eurodollar system. Estimates range from $10 trillion to over $20 trillion. It's essentially a shadow network of dollar finance stretching across the planet. Which brings us back to that moment in 2008. When the financial crisis hit, European banks suddenly couldn't roll over their dollar funding. They had borrowed heavily in dollars to finance investment, but when markets froze, they couldn't get the dollars they needed. So the U.S. Federal Reserve did something extraordinary. It opened swap lines with foreign central banks. This allowed them to borrow dollars directly from the Fed and distribute them to their own banking systems. In other words, the U.S. Central Bank became the lender of last resort for the entire world. That's how central the dollar system had become. But systems built on dominance always attract challengers. In recent years, countries have started talking about de-dollarization. China wants more global trade in yuan. Russia has pushed alternative payment systems. Some nations are experimenting with currencies for oil and commodity trade. On the surface, it sounds dramatic: the end of dollar dominance. But the reality is more complicated. Replacing the dollar isn't just about choosing a different currency. You would need to replace the entire infrastructure: the bond market, the financial plumbing, the trust built over decades, and most importantly, the sheer scale of dollar liquidity. That's incredibly hard to replicate. Even China's economy, second largest in the world, still maintains capital controls. Money can't flow freely in and out. For a currency to dominate globally, investors must trust that they can move money without restriction. That level of openness is rare, which means the dollar's biggest advantage might not be strength. It might be the absence of alternatives, but that doesn't mean the system is risk-free. In fact, the global dollar system creates a strange paradox. Because the world depends on dollars, the United States must supply them. And the easiest way to supply dollars to the world is by running trade deficit. America imports goods. Dollars flow overseas. Those dollars then return to the U.S. financial system through investments in Treasury bonds and other assets. It's a giant recycling loop. But it also means the United States constantly accumulates debt. Right now, U.S. government debt exceeds $34 trillion, and the number keeps rising. For decades, the global demand for safe dollar assets has helped absorb that debt. But the bigger the system becomes, the more fragile it can feel.
Because if confidence in the dollar system ever seriously cracks, the consequences wouldn't just hit the United States, they would ripple across the entire global economy. After all, when the operating system of global finance glitches, everything connected to it feels the shock. Banks, trade, investment, currencies, entire economies. Which brings us to a strange conclusion. The dollar dominates not just because America is powerful, but because the entire world is entangled in a system built around it, a system reinforced by markets, institutions, and decades of habit. The question isn't simply whether the dollar will remain on top. The deeper question is this: if the global economy ever decides to move away from the dollar, what would replace the system that keeps it there today?